Hello, everyone. Welcome back to Money and Banking. We're continuing our discussion of interest rates. Today, we're going to be learning about the risk and term structure of interest rates. In our last series of lectures, we talked about bonds that had identical maturities and looked at the interest rate structure when they had different risk, or different liquidity, or when they were dealt with differently in terms of tax characteristics. Now we're going to go ahead and we're going to reverse that, right? We're going to hold the risk associated with the bonds that we're looking at as constant, their liquidity and their tax characteristics. In fact, we're going to be assuming that they have all identical risk, liquidity, and tax characteristics, but we're going to look at how differences in the maturity of the bonds impact differences in interest rates. Our lecture on the term structure of interest rates will focus heavily on the yield curve. The yield curve is a plot of the yield on bonds with differing terms to maturity, but of course the same risk, liquidity, and tax considerations. Our yield curve, really, which just plots out the yield over differing maturities, can sometimes and most frequently be upward sloping, in which case the long-term rates are above the short-term rates, hence upward sloping. It can be flat, where short and long-term rates are the same, roughly. Or in special cases, it can be inverted. And we'll talk a little bit about inverted yield curves and their role historically as an economic indicator. When you have an inverted yield curve, the long-term rates are below the short-term rates. When we're coming up with a theory of term structure, something that will explain the yield curve, right, it must correspond to what we generally see happening with the yield curve. And so the theory of term structure of interest rates must explain the following facts. Number one, interest rates on bonds of different maturities tend to move together. They seem to be connected over time. Number two, when short-term rates are low, yield curves are more likely to have an upward slope. When short-term rates are high, yield curves are more likely to have a downward slope and be inverted. And number three, yield curves almost always slope upwards. We'll be looking at three theories that try to explain these facts that we saw in the last slide. One of them will be expectations theory, and it's good at explaining the first two facts, but it doesn't explain the third one very well. Segmented market theory explains the third fact, but it's not very good at explaining the first two. And liquidity premium theory, which combines these two theories, expectations and segmented markets, and explains all three of our facts. Figure number 4, the movements over time of interest rates on U.S. government bonds with differing maturities. We're not looking at a yield curve here. We will be looking at some shortly, right? We're actually looking at multiple yield curves. A yield curve for every year between 1950 and 2000, and probably about 17 there, right? Let's sort of dissect this diagram, if you will. Our green line is 3-month bills. These are U.S. Treasury bills, so they have zero risk of default. They're very deep liquid markets, and they have equivalent tax considerations. Our blue line is going to be sort of a medium-term bond, also a Treasury, U.S. government bond, 3 to 5 year interest rates, right? And then our long-term bond will be the 20-year bond, right? And we're looking at average interest rates over these three categories of bond markets through time. Now, what you should be able to see is something like the yield curve. In fact, if we took a cross-section of the yield curve from, say, 1994, we would see that interest rates on short-term bonds are low, interest rates on medium-term bonds are slightly higher, and interest rates on long-term bonds are higher still. So we've got an upward-sloping yield curve there. You can see that most of the time we're seeing that upward-sloping yield curve, right? The lines ascend from short term to medium term to long term, or green to blue to red. So one of our facts there, the yield curve tends to be upward sloping most of the time. Another one of our facts is that, well, these bond rates seem to move together, right? They all kind of move up at the same time. They all kind of move down at the same time. They all follow generally the same behavior. And so we've got our first fact, of course, that these interest rates tend to be related to each other, right? We've also got our second fact, right? When short-term rates are low, long-term rates tend to be high. And on the few occasions that we see the short-term rates climb up above long-term rates, right, we tend to see this curve become inverted, right? Now, I will say that the sort of insight on the inverted yield curve is a little bit folk wisdom and a little bit of policy analysis by an economist named Harvey at MIT. And what Harvey noticed at MIT was that for at least the last 50 years, anytime you get an inverted yield curve, right, where short-term rates move above long-term rates, you tend to have a recession shortly thereafter. And over the last 50 years, this has been true, this sort of, prophecy, if you will, where inverted yield curves lead to recessions. This sort of forecast, if you will, has been correct at predicting recessions all times but one. And so there's some interesting sort of, at least folk wisdom involved in that. And it's commonly referred to in the press and in financial markets as being an indicator of recessions, but we certainly saw an inverted yield curve in the early 80s before the savings and loan crisis, in the early 90s before a recession then. We saw an inverted yield curve just before the dot-com bubble burst in 2000, 2001. And we also saw an inverted yield curve just before the Great Recession, the mortgage-backed security recession in 2006, 2007. I will also note that in 2019, or early 2019, around March, we saw an inverted yield curve extending through the summer months. And one of the concerns was that this would lead to a recession, even though in middle and late 2019 the economy was still roaring ahead, probably even in the direction of overheating, one might say, in hindsight. So, was our most recent inverted yield curve a harbinger of recession? It's hard to say because, of course, something very atypical got thrown into the mix, which was the COVID-19 pandemic, which most certainly generated a recession. But, the jury is still out as to whether or not we would have had a recession in the absence of the biological shock to the economy. Let's take a look at our theories, right? We're going to dive into each of them and take a look at how they might explain our facts regarding yield curves. The first theory that we're going to be looking at is called expectations theory. The idea here is that the interest rate on a long-term bond should equal an average of the short-term interest rates that people expect to occur over the life of the bond. I mean, the idea here is if you want to have an investment for 10 years, there's two different ways to do it. One of them is you could buy a 10-year bond, and the other way is, of course, you could buy 10 one-year bonds. Now, you would probably buy or sell, the long-term versus the short-term bond until you were indifferent between those two options. And so this is kind of the idea underlying expectations theory, and this idea that there should be an equivalency between long-term bonds and equivalent investments in short-term bonds over the same period of time. The idea here is that buyers of bonds do not prefer bonds of one maturity over the other. They don't really care about the maturity. All they care about is the expected return. So they're not going to hold any quantity of a bond if its expected return is less than that of another bond with a different maturity. Right? So we want to see an equivalence here between buying a 10-year bond or buying an alternative asset which is equivalent to it, right? 10 one-year bonds. Bondholders consider bonds with different maturities to be perfect substitutes, and they really differ between them only in terms of their relative rates of return. Let's look at an example. Let the current rate on a one-year bond be 6%. You expect the interest rate on a one-year bond to be 8% next year. All right, so this year it's 6%, next year it's 8%. Then the expected return for buying two one-year bonds would be the 6% plus the 8% divided by the 2 bonds, the two periods that you're holding, or 7%, right? So you buy one bond, you buy a bond the next year, you look at your rate of return, it functions out to be 7%. The interest rate on a 2-year bond, right? Not 2 1-year bonds, but a 2-year bond must also be 7% for you to be willing to purchase it. Now, if that were not true, say the interest rate on the 2-year bond was 6%, right? Then you would be looking at a market where you could buy 2 1-year bonds and earn an overall 7%, or 1 2-year bond and earn 6%. You wouldn't buy the 2-year bond. Nobody would, right? And so prices in that market would be falling, and as prices in the 2-year bond market declined, the interest rate would increase on 2-year bond markets until people were willing to buy them. That would occur as soon as, right, the interest on the 2-year bond was equivalent to that of our 2 1-year bonds at 7%. So markets should push prices and interest rates on bonds of differing maturity until they are equivalent in this way. This is the essence of the expectations theory. Let's look at a proof of this for an investment of $1, right? IT is the interest rate today on a 1-period bond. The expected interest rate on a bond 1 year in the future, T plus 1, is IE sub T plus 1, the interest rate on a 1-period bond for the next period. Right? I2T is today's interest rate on the 2-period bond. So we're comparing a bond bought today, interest rate being IT, a bond bought next year, interest rate IE sub T plus 1, or the interest rate on a 2-period bond, I2T. Continuing on, let's calculate the expected return for the 2 periods from investing $1 in the 2-period bond, right? We're going to hold it all the way to maturity. In the first period of time, we'll earn the interest rate I2T. In the second period of time, we'll earn the interest rate I2T. We want to back out the expected return now, so we're going to take our returns, subtract out the 1 so we can isolate the interest rate, the expected return that was involved. Running through the math on this, we can skip ahead to line 3. The expected return for the 2-period bond will be 2 I sub 2t plus I sub 2t squared. Now the trick here is that I sub 2t squared is minuscule. It's extremely small. And so we're really just going to throw it away. What we've done now is we've isolated the expected return for holding the 2-period bond through its maturity. And that rate of return on the 2-period bond will be 2 I sub 2t. So now we've got our expected rate of return on our 2-period bond. Let's compare it to the expected rate of return on 2 1-period bonds. So hold that 2 I sub 2t in your head, our 2-period bond expected. If on the other hand, right, we were looking at 2 1-period bonds and investing the same equivalent $1 investment, what we would have is the following. In the first period of time, we would earn, right, the $1 plus the interest rate I sub t, and in the second period, we would earn, right, IE sub t plus 1, the expected interest rate that would be prevailing in the second period. We're going to subtract out 1 to back out the expected rate of return, and we can go ahead and run the math on that. And the expected rate of return for 2 1-period bonds would be I sub t plus IE sub t plus 1 plus I sub t multiplied by IE sub t plus 1. The last term in that third line is again minuscule. It's extremely small. So we'll throw it out and simplify, and what we get is that the rate of return for 2 1-period bonds is I sub t plus IE sub t plus 1. Now, our statement about expectations theory said, right, if markets are fluid and flexible, people have good information about the rates of return in each market, then they're going to move back and forth between the long-term and the short-term bond markets until there is no difference in rate of return between the two. So that is the statement essentially on the first page of this slide. Both of the bonds will be held only if the expected returns are equal. Otherwise, there's going to be buying and selling going on, pushing around prices and pushing around expected rates of return. So in equilibrium, this first statement, the first mathematical statement on this slide, has to hold true. On the left-hand side, again, we have the expected rate of return on the 2-period bond. And on the right-hand side, we have the expected rate of return on 2 1-period bonds, right? The statement is that those have to be equal. Our second line really just simplifies this equilibrium expression, right? And what it says is that the 2-period rate must equal the average of the 2 1-period rates for bonds with longer maturities. So we can generalize this statement and say that a long-term bond rate of any maturity, and let that maturity be n, the number of periods of time that it's out, should be equal to the average of short-term interest rates occurring over that maturity time span n. And so the third line is really the statement of expectations theory's motivation for determining the relationship between long-term and short-term interest rates. N, of course, is the maturity, and the n-period interest rate must equal the average of 1-period interest rates expected to occur over the life of the bond. Now, you should see a couple of our facts explained here, right? This equation is telling you why the term structure of interest rates changes at different times. It explains why interest rates of bonds with differing maturity are going to move together because, interest rates on long-term bonds are determined by expected interest rates on short-term bonds over a period of time. It helps to explain why the yield curve tends to slope up when short-term rates are low, because if short-term rates are very low but expected to go back to some normal level in the future, the first two sort of terms in the numerator on the right-hand side are going to be abnormally low, and they're going to be weighted less heavily, considering that we're taking into account an average of all the expected interest rates, right? So it says, okay, if interest rates are very low, they're probably going to even out over time, and the yield curve is going to slope upward. If, on the other hand, short-term interest rates, say IT and IT plus 1, are very high, well, this is an abnormal situation. That's why we say they're high. And so interest rates in T plus 2, T plus 6, T plus 7 are going to be probably much more normal and much lower, and that would explain why, when short-term rates are high, the yield curve tends to slope down, if you will. But unless we're assuming, right, that there's going to be a general progression upward in short-term interest rates in the future, which we are not assuming, then really we have no way of explaining or motivating why the yield curve usually slopes upward, right? If the yield curve usually slopes upward, that would mean that, right, interest rates occurring in the future are always or generally expected to be much higher than they are today. And we don't have a motivating thesis for that. So we can't really explain why the yield curve would generally slope upward underneath general sort of conditions, right? And so that last little fact in our analysis of, what are common facts pertaining to yield curves is not something that's bearing out well in this equation. So you want to hold that equation in your head because that really is a nice little summary of the expectations theory. Expectations theory, again, it's going to explain why the term structure of interest rate changes at different times. It talks about why interest rates on bonds with differing maturities will move together through time. And it explains to us why yield curves tend to slope up when short-term rates are high and tends to slope down when short-term rates are high. Hopefully you caught the verbal typo there. Yet, right, the expectations theory cannot explain why yield curves are usually sloping upward. Let's take a look at our second theory of term structure of interest rates, the segmented market theory. Bonds of differing maturities in this theory are not considered to be substitutes. In fact, not at all, right? So these markets for long-term and short-term bonds are segmented. They're broken, right? There's a chasm between them. The interest rate for each bond with a different maturity is determined by supply and demand in that bond market. And since they're considered to be not substitutes, you won't see buyers and sellers migrating from long-term to short-term markets, right? And in our expectations theory, that movement in and out of the long-term or the short-term market, right, is what drove the interest rates on these differing maturity assets to be equivalent, right? It was that shopping, that movement, right? If the rate is too low on long-term bonds, I'll buy short-term bonds, thereby pushing up the rate of long-term bonds, right? So segmented market theory is really negating or breaking that mechanism of trading between markets, which occurs if investors view long and short-term bonds as, substitutes that are indifferent between the two, except for rates of return. It breaks that mechanism up so that we no longer have to see interest rates on long-term bonds equate to averages of long-term bond interest rates, right? In the segmented markets theory, the markets are distinct. They're not considered to be substitutes. They have different sellers and different buyers motivated by different concerns. Investors are assumed to have a preference for bonds with one maturity over the other. People just like long-term bonds, or people just like short-term bonds, and this is their preference. And so they'll either trade in the market for short-term or long-term according to where their preferences lie. If investors generally prefer bonds of shorter maturities that have less interest rate risk, then this explains why yield curves usually slope upward. Because if you think about it, right, if people are moving a lot of their buying into the short-term market in order to avoid interest rate risk, they're going to be pushing up the price of short-term bonds and push down the yields on short-term bonds. Therefore, right, generally speaking, right, the yield curve will be upward sloping. Interest rates on short-term bonds will be quite low, and interest rates on long-term bonds will be higher than that, essentially because, right, you're factoring in interest rate risk and liquidity concerns. Well, segmented markets theory explains the third fact, but not the first two. So let's come up with a new theory, kind of a hybrid theory. You can think of this as blending the two theories to some extent, right? That will explain all three of our factors. This theory that explains all three of our facts is called the liquidity premium theory and the preferred habitat theories. They're kind of combined together to get an overarching theory that explains all three of our facts. The interest rate on long-term bonds will equal an average of short-term interest rates expected to occur over the life of the long-term bond, plus a liquidity premium that responds to the supply and demand for conditions of that bond. So what we're saying here is that the first part of this little bullet point says, hey, expectations theory is valid. Right? And so long-term bonds will equal the average of short-term bond interest rates occurring over the same maturity. The second part of this says that they're not actually perfect substitutes. There's something unique about long-term bonds that will cause it to have an additional premium. That additional premium is the liquidity premium, what we call the liquidity premium, right? The idea is that if you're holding a 1-year bond to maturity, you've lost your liquidity for only 1 year. If you've bought a 10-year bond, well, you're parting with your liquidity for 10 years. And so there's a downside to having, less liquidity, for losing your liquidity for a longer period of time. And long-term bondholders will have to be compensated for that downside by attaching a little bit of a premium to the interest paid out on long-term bonds, an additional incentive to hold long-term bonds, an additional incentive to, right, face that downside of longer maturity lost liquidity, if you will, right? And so we're just going to tack that on to the expectations theory, this liquidity premium. Bonds of differing maturities are partial, not perfect substitutes. So they're not perfect substitutes. They're not substitutes, as in the segmented market theory. They are substitutes, but there's friction between them, and it's that liquidity that is the friction that makes them, not perfect substitutes. The mathematical expression of the liquidity premium theory is fairly straightforward and kind of easy to memorize because it really is something you already know, which is the expectations theory, right? That the interest rate on long-term bonds will equal an average of the interest rates occurring over the maturity of the long-term bond. And that, of course, motivated theories 1 and 2, right? That these generally move together, and that when short-term rates are extremely high or low, it will, invert or keep a very steep yield curve. But we tack on to that an additional premium, right, that applies to long-term rates that says, yeah, long-term rates are going to be equal to the average of short-term rates plus a little bonus that comes from needing a liquidity premium to hold on to or to have lost your liquidity for the life of the long-term bond. And so that little term, the very last one on the right-hand side, liquidity premium over the life of the bond at time t, right, pushes up the long-term rate above short-term rates. And the longer the maturity out is, the higher the liquidity premium would be, right? So if we expected interest rates to be absolutely constant over the period t through n, right, t0 through tn, then we just see a flat line, right? The interest rate on a 10-year bond would be equal to the interest rates on 10 one-period bonds, and if the interest rate over each of those 10 periods was 5%, then the long-term rate would equal the average of that, right? But a 5-year bond would be a straight line, but with a little plus, a little liquidity premium theory on there. And a 10-year bond would have an even higher liquidity premium on there. And a 15-year bond would have yet an even higher liquidity premium on there as well. So you should see, right, interest rates moving together, yield curves either being downward sloping or upward sloping when short-term rates are abnormally high or low, and also theory number 3, that generally speaking, yield curves tend to be upward sloping. That liquidity premium is what drives that. Preferred habitat theory, right, softens up the segmented market theory to allow us to really place that liquidity premium in our equation. Investors are assumed to have a preference for bonds of one maturity over the other, right? They're likely to prefer short-term bonds over long-term bonds, but they could be convinced to buy longer-term bonds if they were incentivized to do so, such as earning a liquidity premium. This is a diagram that sort of expresses what's going on there, right? If interest rates are expected to stay constant over 30 years, then the expectations theory yield curve would be flat, right? But if we add the liquidity premium in, and if we assume that that liquidity premium grows the longer the maturity of the bond, so that liquidity boost is bigger for a 15-year bond than it is for a 5-year bond, right? Then we should see an upward sloping yield curve. Our liquidity premium and preferred habitat theories, well, interest rates on different maturity bonds move together over time, and this is explained by the first term in the equation, that first term being equivalent to our expectations theory, and that explains our fact number 1. Yield curves tend to slope upward when short-term rates are low and tend to be inverted when short-term rates are high. This is explained by the liquidity premium term in the first case as well, and by the low expected average in the second case. Yield curves typically slope upward, explained by a larger liquidity premium as the term to maturity lengthens. Here are some different yield curves. These are, really rudimentarily drawn, if you will. Yield curves and market expectations, future short-term interest rates according to the liquidity premium or preferred habitat theory. Let's talk a little bit about these, right? Let's move to panel B. This might be a pretty normal yield curve, right, that incorporates all of our theories. It's generally upward sloping. Now, move to panel A, right? This looks to be an extremely steep yield curve. Why might that be? Well, one of the reasons might be that short-term rates are extremely low relative to expectations of long-term rates. Another reason might be that investors are expecting future interest rates to be much higher, right? And so that's pushing up the curve. Why might you expect future interest rates to be higher? Maybe because you're expecting inflation over the longer horizon of the yield curve and demanding that you are sort of compensated for that with higher interest rates. Our flat yield curve, of course, is the expectation that future interest rates are going to be lower than they currently are. that lowers the IE T plus 7, IE sub T plus 8. And if those expected future interest rates fall enough to overcome the liquidity premium, then of course you get a flat yield curve. And last but not least, our inverted yield curve, which we talked about as maybe being a bellwether of a recession. This can occur if short-term rates are abnormally high, or again, if expectations about future interest rates are so low that they counteract the liquidity premium theory. Now, there's yet again one other reason why you might get inverted yield curves. And it's the idea that, of course, U.S. government bonds are the absolute safest asset ever. So if you are expecting trouble on the horizon, maybe you're expecting inflation on the horizon, right? You might move a lot of assets into long-term bond markets. So this can express some trepidation, some fear, worries about the economy, right? And so you drive up your purchases of long-term bonds. That pushes up the price of long-term bonds and pushes down rates on long-term bonds. So worries about heavy inflation, worries about recession, right, might show up as people engaging in what we call a flight to quality as they move out of assets that have risk and into assets that have no risk, such as U.S. government long-term bonds, thereby driving those rates down and inverting the yield. Here's our yield curve for some selected periods of time. July 24th, 2017, an upward sloping curve, right, reflecting a very normal circumstance for the economy. Note our inverted yield curve, the very top one. This is occurring on January 15th, 1981, so just before the savings and loan crisis, and certainly a predictor of that recession, if you will. Fairly normal yield curve, upward sloping. It looks like almost a perfect example of our liquidity theory and preferred habitat theory occurring on March 28th, 1985, if you will, right? So these are what your yield curves might look like. We've used some simple diagrams of them to make them a little bit easier to digest, but of course this is what you'd be more likely to see. All right, everybody, I hope you enjoyed your lecture on term structure varied by maturity. Keep in mind our three theories of the yield curve, if you will, and also keep in mind some of those fundamental equations that help to root your ideas about expectations theory and liquidity premium theory. They're very closely related, so fairly easy to memorize, right? And we'll see you next time. Thank you for your time. I hope you have a beautiful day.